This was not a normal sell-off. This was not just another red candle. What just happened in silver is being called the biggest dump since 1980. And if that comparison is even partially true, then the question everyone should be asking right now is simple. What happens next? Because when a market moves like this, it doesn't just reset price, it resets psychology. Welcome back to Silver Pules. If you're watching this right now, chances are you're either shocked, frustrated, or trying to figure out whether this move was a warning or an opportunity. And you're not wrong to feel that way. Moves of this size don't happen quietly. Ads leave damage behind, but they also leave information. Before we break it all down, take 1 second to like this video and subscribe to Silver Pules. It helps the channel grow and make sure you're not navigating moments like this alone, especially when the silver market is testing everyone's patience. Now let's rewind. It was dumped, hard, aggressively, in a way that instantly erased weeks and months of progress. Support levels that many traders trusted didn't just fail, they collapsed. Stops were triggered almost all at once. Liquidations followed, and price cascaded lower before most people could even react. When analysts compare this move to 1980, they're not saying history is repeating perfectly. They're pointing to scale, speed, shock, the kind of move that changes how people think about a market. Back in 1980, silver didn't just crash, it broke confidence, and confidence takes far longer to rebuild than price. That's why this moment matters, because silver is not just a chart, it's a belief system. It's tied to inflation, fears, monetary trust, industrial demand, and long-term protection. When silver dumps this hard, it shakes more than portfolios. It shakes narratives. So why did this happen? On the surface, you'll hear simple explanations. Strong dollar, high interest rates, risk-off sentiment. But those are ingredients, not the trigger. The real issue was structure. Silver had been trading in a fragile balance. Liquidity was thin. Leverage was high. Speculative positioning had built up quietly. When selling finally started, there was no shock absorber. Large sell orders hit during low liquidity periods. Price dropped fast. Algorithms amplified the move. Margin calls forced more selling, and suddenly what started as pressure turned into a dump. This is how modern markets break. It's not with one big headline, but with a chain reaction. Now here's the part most people miss. Crashes like this are not evenly distributed. You don't punish everyone equally. You punish the most emotional, the most leveraged, and the most impatient participants first. That's not cruelty. That's mechanics. If you were overextended, this move hurt badly. If you were all in emotionally, it probably shook your confidence. And if you were watching silver as a long-term asset, you're probably wondering if something fundamental has changed. That's the key question. Did silver break? Or did positioning break? Because those are very different things.
Ow.
Look beyond the price for a moment. Industrial demand for silver did not disappear overnight. Solar production didn't stop. Electronics manufacturing didn't vanish. Medical demand didn't collapse. None of that changed in a few days. What changed was sentiment. Sentiment is the fastest thing to fall in any market. Another important detail is the disconnect between paper silver and physical silver. As spot prices dropped sharply, physical premiums in many places did not fall at the same speed. In some cases, they barely moved. That tells you something. Paper markets can dump unlimited contracts in seconds. Physical markets cannot. They move slower. They reflect real supply and demand. This gap is where confusion lives, but it's also where clarity can be found if you're patient enough to look. Now let's talk about fear. Fear is loud right now, and fear loves extremes. It tells you silver is finished, or that it's about to explode tomorrow. Both narratives are dangerous. Markets rarely reward emotional certainty. Historically, after massive silver dumps, price does not immediately recover. It stabilizes, it chops, it frustrates, it tests conviction. That's the part most people don't talk about. The worst damage is not done during the crash, it's done afterward, when boredom, doubt, and second-guessing take over. This is where many investors make their biggest mistakes. They sell after the damage is already done, or they rush back in too early, hoping for a fast bounce that never comes. At Silver Pules, we focus on behavior, not hope. And right now, the behavior to watch is simple. Does selling pressure continue at the same intensity, or does it slow? Do breakdowns accelerate, or do they start failing? Do rallies get rejected instantly, or do they begin to hold? These answers won't come from headlines. They'll come from price action over time. Another thing to understand is that silver has always been a market that overreacts. On the way up, it excites. On the way down, it terrifies. That emotional range is part of why silver moves the way it does. The comparison to 1980 matters because that era also followed extreme positioning, extreme emotion, and extreme narratives. When those unwind, the move is rarely gentle. But here's the part that often gets ignored. After the dust settled in past cycles, silver didn't disappear. It reset, it rebuilt, and eventually it moved again, in ways very few people expected at the time. That doesn't mean prices must go up from here. It means this move should be seen as a phase, not a conclusion. If silver were truly irrelevant, it wouldn't attract this much capital, this much leverage, or this much attention. Markets don't dump what nobody cares about. They dump what people are crowded into. So, ab Cuyahoga. But the honest answer is this. The next phase will likely be slower, quieter, and mentally harder than the crash itself. Volatility may remain high, but direction will be less clear. That's where discipline matters most. This is a moment to observe, not panic, to reassess risk, not chase revenge trades, to remember why you were watching silver in the first place. If your thesis was short-term speculation, this move changes everything. If your thesis was long-term value, this move demands patience, not fear. And if you don't have a clear thesis at all, this is your signal to step back and get one, because silver doesn't forgive confusion. If you've stayed with me this long, you're exactly the audience Silver Pules is built for. Make sure you're subscribed, because the next few weeks in silver will be more about psychology than price, and that's where most people lose their edge. Before we wrap up, I want your input. Do you believe this dump marks a long-term bottoming process? Or do you think silver still needs more time and pain before it stabilizes? Drop your thoughts in the comments. Different views make this conversation stronger. And if you know someone who's stressed or confused watching silver right now, share this video with them. Calm analysis spreads faster than panic if people let it. Markets move in cycles. Fear peaks near extremes. And the moments that feel the most uncomfortable are often the most important ones to stay grounded. Thanks for watching Silver Pules. Stay patient, stay aware, and I'll see you in the next update.